Is there something better than U.S. bonds? What about international bonds? And with inflation protection? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, there seems to be no end to the conflict with Iran at this point in time. And with oil and gas prices increasing and driving up inflation, many of the regulars here are starting to wonder how safe their treasuries really are. And a few are even thinking whether they should look for safe havens outside our borders. And they seem not to be alone. Investors appear to have been flocking into WIP, an ETF that invests in international government inflation-protected bonds. Its assets under management have been growing by an astonishing annualized rate of 138% between January 29th, 2026 and May 13th, 2026, the time of this taping. For comparison, the domestic iShares TIPS Bonds ETF, ticker TIP, has seen its asset base grow as well, although a bit less at an annualized rate of only 31%. So, with that renewed interest in inflation protection and potential international diversification in mind, here are the three topics I'll be covering today. 1. What are the latest inflation readings in the US, and might prices go up further? 2. Have international inflation-protected bonds performed better than U.S. Treasury inflation-protected securities, TIPS? And 3, what's our personal inflation protection strategy and perspective on diversifying internationally into inflation-protected bonds? Let's dive in now, folks. What are the latest inflation readings in the U.S., and might prices go up further? With the Strait of Hormuz still closed and oil prices hovering around $100 per barrel, many in our Diamond NestEgg community, us included, were expecting inflation to go up, but even we were surprised at how bad the numbers were when they came out. On Tuesday, May 12, 2026, the Bureau of Labor Statistics reported that the Consumer Price Index was up 3.8% year over year in April, the highest reading since early May 2023. And the next day, the Bureau of Economic Analysis published an even higher 6% year-over-year increase for the Producer Price Index, the largest since December 2022. This last number may even be more scary because producer price inflation tends to be seen as a leading indicator for consumer prices. It's generally not a direct one-to-one relationship, but if it costs producers 6% more to produce their goods and services today than a year ago, then it's probably a fair bet that consumers will have to pay more as well when these products hit the shelves at some point down the line. So, while we're still a bit away from the post-COVID inflation peaks, quite a number of you in our community are wondering again what higher inflation might mean for your treasuries and how you might be able to protect your savings and income, bringing us nicely to the next part of today's discussion. Have international inflation-protected bonds performed better than U.S. Treasury inflation-protected securities, TIPS? Now, there are several options for protecting your portfolio against rising prices as a retail investor. Our personal preference is for real assets such as equities and real estate, and to some extent I-bonds, while others prefer commodities and precious metals. What's been top of mind currently for quite a few of our Diamond NestEgg folks, though, is inflation-protected bonds, not surprisingly, and in particular, TIPS, Treasury inflation-protected securities. So that's what we'll be focusing on today. TIPS versus their international equivalents. And for VIP Investment Club members, consider today's episode a very first taste of what's to come in the next several months in our member zone. As quite a few of you have requested over the past several days, Marcus and I will start working on some more member videos on international bond investing. And for those of you who are also interested in foreign bonds, inflation protection, and how these investments might fit within our or your base and boost strategy, come on over and join the growing member community in our VIP Investment Club, where these conversations are happening practically every day. There's only 4 days left to save. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP investment club membership before Sunday, May 17th, and just in time to join this month's Member Live on Memorial Day weekend. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more, or this bond course bundle button if that's what you're more interested in. I've also linked everything below this video for your convenience. So, Treasury inflation protected securities, or TIPS. Like normal treasuries, TIPS enjoy the full faith and credit of the U.S. government, and if used for the right purposes, TIPS may protect you against inflation and help you sleep just a bit better at night. We've talked a lot about them on this channel in recent years, so we won't repeat the basics. Bond beginners, folks, please refer back to Module 6 in the course for a TIPS refresher. For today, we'll compare an investment in a TIPS ETF versus an investment in an ETF that holds international government inflation-protected bonds. And let's do this with our usual fund comparison table, of course. Here you have the name of the fund, followed by the ticker symbol and when it was established. Next come the total assets under management in billions of dollars, the dividend frequency, how often a dividend is paid per year, and the expense ratio. Finally, we have the price per share and the TTM, the trailing 12-month distribution yield, which tells us how much in cash this fund distributed to its owners over the past 12 months as a percentage of the share price at the end of the last period. And finally, the trailing total returns on an annualized basis. These numbers tell us how much a shareholder would have made overall from both dividends, cash payouts, and capital gains or losses, price changes of the shares basically, had he or she invested 1, 5, and 10 years ago. Here on top, we have BlackRock's iShares TIPS Bond ETF, ticker TIP. It tracks an index based exclusively on TIPS, U.S. Treasury inflation-protected securities, with an effective duration of 6.41 years. It was established in 2003 and has grown to $15.02 billion in assets at the time of this taping on May 13th, 2026. As I mentioned before, this is up from $13.8 billion in assets per January 29th, which gives us an annualized asset growth rate of 31%. Not bad for a bond ETF. TIP has an expense ratio of 18 basis points. So, let's look now at State Street's SPDR FTSE International Government Inflation Protected Bond ETF, ticker WIP, as our international comparison. WIP is an index ETF that tracks inflation-linked bonds of developed and emerging market governments outside of the U.S., with an effective duration of 8.81 years. So a bit longer than for TIP. At the time of this taping, its 10 largest holdings of inflation-protected bonds by geography came from European countries such as the United Kingdom, France, Italy, Spain, and Germany, but also from other continents and even some more emerging markets such as Israel, Australia, Japan, Brazil, and Mexico. WIP was established back in 2008. But despite the recent annualized growth rate of 138% since January 29, 2026, that I mentioned before, it is still relatively small, with $525 million in assets under management at the time of this taping. WIP pays dividends monthly and has an expense ratio of 50 basis points. Let's now compare the track record of these two funds, keeping in mind that all the numbers we're going to compare are the latest as of the time of this taping per May 13th, 2026, and that past performance is not indicative of future results or outcomes. So, starting with the TTM, trailing 12-month distribution yield, the cash distributions from the past 12 months, the international fund wins with 5.22% for WIP versus only 2.77% for TIP. Now, let's look at the trailing total returns, the sum of the cash distributions plus any capital gains or losses from share price movements. More recently, the international WIP has outperformed the domestic TIP fund hands down over the past year. It was 12.99% for WIP versus only 5.61% for TIP, which, by the way, may also explain the recent higher interest in international bond funds, not just as diversification and potential risk mitigation, but also simply for some potentially higher returns. That said, the picture reverses if we look back at longer investment horizons. Here, the domestic fund wins. The international WIP performed worse than domestic TIP over the past 5 years. Negative 0.12% for WIP versus a positive 1.13% for TIP. As well as over the past 10 years, only 1.63% for WIP versus 2.59% for TIP. So the picture so far is that the international WIP paid higher cash distributions, but had worse total returns over the past 10 years, which means that its share price must have gone down. And this chart here confirms it. TIP, the dark blue line here, has some ups and downs, but overall, its share price was relatively stable and is down only by about 3% over the past 10 years. The international WIP, on the other hand, the purple line, lost almost 26% of its initial share price over the same period. However, you can also see an uptick in WIP's share price since early 2025 that helps explain its recent outperformance against a weakening dollar, as discussed. And remember, unlike with individual bonds, you can't hold an ETF or fund to maturity. Whenever you want to access your principal, you will have to sell your shares at whatever the then current market price will be. So where does this complicated picture leave us, right? Do you stick with domestic TIP for its historical track record of more stable share prices and higher total returns in the long run? Or are you tempted by international WIP, or even own it already because you like its higher cash distributions and suspect that the future may look more like the last 12 months where it has outperformed? Or maybe you can't decide and are thinking of owning both to diversify your portfolio. Drop a comment below and let me, Marcus, and everyone else know. Or even better, come on over and join the growing member community in our VIP investment club, where lively conversations like these are happening practically every day. Not just about inflation protection and international investing, but much more. There's only 4 days left to save. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP investment club membership before Sunday, May 17th. And just in time to join this month's Member Live, as I mentioned earlier, on Memorial Day weekend. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more, or this bond course bundle button if that's what you're more interested in. I've also linked everything below this video for your convenience. So, as I always say, everyone's financial journey is different, and you need to do what's right for your personal situation when it comes to WIP versus TIP, which leads us nicely to the next part of today's discussion. What's our personal inflation protection strategy and perspective on diversifying internationally into inflation-protected bonds? As our Diamond NestEgg regulars know, Marcus and I own U.S. inflation-protected securities in our personal portfolio, specifically I-bonds, as part of our liquid emergency and retirement fund after the 1-year minimum holding period is over. What we really like about I-bonds is that you can always redeem them at full face value, 12 months after purchase, even if you do have to pay an early withdrawal penalty of the last 3 months' interest if you redeem within the first 5 years. There's just simply nothing out there like it. For overall inflation protection, though, we rely on the real assets in the boost part of our portfolio. We could see a potential case for holding TIPS for medium to longer term investing in the base part of a portfolio once you get closer to retirement or are in retirement and really want a fixed income investment that adjusts to inflation. Even then, though, we would likely hold TIPS directly as part of a ladder and not via a fund, as this gives us the advantage of what we call the 3 C's of buying and holding individual bonds: clarity, control, and lower cost. We don't own any international inflation-protected bonds, but we hold some international assets from our time working in London and Frankfurt that help us diversify our portfolio and potentially protect us against inflation. That said, if you were to ask us who we could see as a fit for an international inflation-protected bond fund like WIP, I would say that you might want to consider WIP if you fall into one or more of these three categories. 1. You've reached a certain critical mass in your portfolio where you think some international inflation-protected bonds will help you diversify and potentially reduce your overall risk. And despite the extra risks that international investment may bring, general portfolio theory may be on your side in such a case. 2. You like the potentially higher cash distributions, as well as the chance for higher total returns from an international inflation-protected bond fund like WIP, and feel encouraged by its strong performance over the past 12 months. As I mention often, though, remember that past performance is not indicative of future results or outcomes, so this will depend on your personal conviction call. 3. Regardless of potential returns, you want to diversify your currency and political risk, as the markets would phrase it. In other words, if you just don't trust how our government measures inflation and or fear for the safety of your dollars and treasuries, or are generally skeptical about the long-term outlook for the U.S. economy overall, some diversification into international inflation-protected bonds might help you sleep better at night, even if the returns were to disappoint you in the future. Again, this will largely depend on your personal outlook and convictions. On the other hand, you should probably not invest in WIP or any other international inflation-protected bond fund if you would not be comfortable with even one of these 5 aspects. 1. An international fund like WIP protects you not against inflation in the US, but against inflation in the issuing country. So, for example, a British or Mexican bond will track inflation in the UK and Mexico, respectively. Now, financial theory says that the exchange rate should balance out the varying inflation rates in different countries in the long run, but that may or may not work perfectly in practice. A direct hedge against U.S. inflation will have less base risk, as risk managers would say, which leads us to point number 2. You don't like the exposure to foreign currency risk. WIP is not hedged against exchange rate movements, and your returns will be influenced by the dollar getting weaker or stronger. This may help you, but it may also hurt you depending on which direction things go. 3. You don't like the lower credit rating and longer duration of WIP. Recall that WIP is rated A versus the AA+ for TIP and its underlying U.S. government risk. Plus, the duration and maturity of international WIP are a bit higher than for domestic TIP as well, as I mentioned already. 4. You can't get the historical underperformance of WIP over longer investment horizons out of your head, and suspect we may see a similar result in the future. Of course, this will depend on your personal assumptions, and maybe you don't like the smaller size and potentially lower liquidity of WIP either. And 5. While domestic TIPS dividends are fully exempt from state and local taxes, like all interest payments from U.S. Treasuries, dividends from international funds are fully taxable at all levels. This may be relevant if you live in a high-tax state and are in an upper tax bracket, and you're buying in a normal taxable brokerage account. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And if you did, remember that you can use the coupon code INCOME2026 to get $100 off of a private VIP investment club membership and our popular bond course bundle on our website at www.diamondnestegg.com through Sunday, May 17th. And see you again very soon with more brand new wealth building content for your financial journey.